The subject of this video is investment grade corporate bond exchange traded funds, which I will abbreviate to ETF, versus direct ownership of corporate bonds. What I'm about to describe as the disadvantages of exchange traded bond funds will also apply to bond mutual funds. Investment grade refers to a credit rating that is at least a BBB minus for S&P and Baa3 for Moody's. Some of these funds will keep a bond in their fund even when one of those ratings but not the other falls into junk territory. For the reasons discussed in this video, my preference is to own individual corporate bonds, and I currently have a diverse portfolio of investment-grade corporate bonds with over 300 different ones. The only advantage to a bond fund from my perspective is the diversity of holdings, which I have already achieved through owning individual bonds. If you live in a state that will tax corporate bond interest, then the next question is how much will that tax reduce your yield compared to interest payments made by simply owning U.S. treasuries whose interest payments cannot be taxed by a state. I live in Tennessee, which does not have a state income tax, so this issue is not relevant for me. As an example of the impact of taxes on yields, I will be discussing in my next post the purchase of a first mortgage bond issued by Energy Arkansas that has a 4% coupon paid on a $1,000 par value that matures on June 1st, 2028. I purchased this one at 97.7, paid a $1 commission to Fidelity. So my total cost is 97.8 or $978 for a $1,000 par value bond. For $1,000 par value bonds, bond prices are expressed at 1/10 of par value in the bond market. Since I bought at a discount to par value, there are two yields to consider. The first is the current yield, calculated simply by dividing the 4% by the total cost number of 97.8, resulting in a current yield of 4.09%. The other yield is called yield to maturity, and I view that as the relevant one when purchasing bonds at a discount. And it will include what I will receive at maturity, representing the difference between the $100 par value and my total cost for this bond of 97.8. The YTM on the date of purchase was 4.704% for this first mortgage bond. Most likely my, quote, profit, end of quote, will be taxed as interest rather than a capital gain under the current IRS code. If I lived in a state that taxes corporate bond interest at 5%, I have to take that into account when comparing the purchase with a treasury note maturing at about the same time. Both are subject to federal taxation, both the corporate bond interest and the treasury bond interest. But the after state tax YTM would consequently have to be lowered to 4.47% if you're paying a 5% state income tax on the corporate bond interest. I just multiplied 4.704 by 0.95% to get that 4.47 number, which is the after tax state tax yield to maturity. If the state had a 10% tax rate, the after-state tax yield would fall to 4.23%. A treasury note YTM maturing on 5/31/28 can be bought in the secondary market last Friday with close to a 4.34% yield, YTM. So why take the credit risk with a corporate bond if you live in a state with a state income tax? That would be true for both the corporate bond fund and the individual corporates. The treasury yield will fluctuate, of course, day to day, hour to hour, and there would be some yield loss occurring when you buy in the secondary market when you're just buying one bond as compared to 100. With individual bonds, I at least have a contractual promise from the issuer to pay par value at maturity. When purchased and assuming that the company survives to pay that par value, I know precisely to the penny what my total return will be. A bond fund does not promise to pay you a sum certain at any time. If interest rates are moving higher, which has been the case starting in March of 2022, the value of the bonds owned by a bond fund will be going down in value. The net asset value per share will be declining to reflect those lower prices. So how did a quality investment grade bond ETF perform over the past 1, 3, and 5 years? This is something you need to check before you buy one. I'm using the Morningstar data as of January 3rd, 2025 for the iShares investment grade corporate bond ETF that trades under the symbol LQD. The data can be accessed by non-subscribers. This is an intermediate bond fund. The performance data is based on total returns, which includes the reinvestment of dividends. The total return over the past year is 1.55% based on price. For data beyond 1 year, the Morningstar data has a total return that is an average annual total return. The 3-year annual average total return of this bond fund, investment grade corporate bond fund, is minus 2.98%. That's minus 2.98% per year for 3 years. The 5-year annual average total return is minus 0.53%. When held in a taxable account, the investor would have to pay income taxes on the dividends of this fund and, if applicable, state taxes. When an adjustment is made to account for inflation, the after-tax inflation-adjusted return would be negative throughout the past 5 years. Investment advisors will use bond funds as a crutch for clients who want a bond allocation. How many explain, I wonder, the disadvantages compared to owning individual bonds? There is a problem for the individual investors who wants a bond allocation but cannot buy individual corporate bonds, assuming they live in a state like Tennessee with no state income tax, in sufficient numbers to achieve diversity, or who live in a state with a state income tax, and that adds a different layer of consideration, as I discussed above. For those investors, building a ladder of individual U.S. treasuries purchased at auction and possibly some in the secondary market to fill gaps in the ladder is an alternative to owning corporate bonds through either a bond fund or individual bond ownership, or even a treasury bond fund, ETF, or mutual fund that has the same problem that I just discussed with corporate bond funds. Take, for example, the 7 to 10 year treasury ETF that trades under the symbol IEF. Morningstar has a 5-star rating on this fund, which sounds good. at first glance. The performance data at Morningstar shows a 1-year total return, that is with dividends reinvested, of minus 0.61% through 1/3/2025. The annual average total returns through 3 and 5 years are minus 4.14% and 1.7% respectively. So that's minus 4.14% for 3 years, if that wasn't clear. If owned in a taxable account, this fund would produce an actual total return that needs to be adjusted further down by federal income taxes that have to be paid on the dividends and by inflation to arrive at what I would call the true total return number, which is what you receive in the total return adjusted for federal income taxes and inflation. And that would be a downward adjustment that would take the actual total return before those adjustments further into negative real territory. How appealing is that to you? That is the end of this video. If I can learn how to